All right, let's dive right in. The silver market is staring down the barrel of a 5-day countdown, a deadline that could really shake things up. But here's the thing. To truly get what's going on, we can't just watch the clock. We've got to look at this thing through 5 totally different lenses. We're talking geopolitics, central banking, the actual physical metal, the price charts, and the deep long-term story. Stick with me and you'll see the entire picture.
So here's our game plan. We're going to start with that ticking clock, the urgent deadline. Then we'll pull back and see the corner the Fed has backed itself into. After that, we'll look at the invisible drain on physical supply, check what the charts are screaming at us right now, and finally, we'll zoom out to that big 36-month picture that the headlines almost always miss. So, what's all the fuss about? Well, everything, and I mean everything, comes down to April 22nd. That's the day a really critical US-Iran ceasefire is set to expire. And nobody has any idea what's going to happen when that clock strikes zero. The entire market is just holding its breath. And all that uncertainty, that's what's pushing people towards safe haven assets like silver. You know, this whole thing just exploded onto the scene. It all started with military action back in late February. Then came this hastily put together ceasefire. But the peace talks fell apart almost immediately, a naval blockade was declared, and now here we are, just 5 days until it all expires. It's a pressure cooker situation. And that brings us to our very first lens, the ticking clock. We're talking about a super short-term, high-stakes game. The market is basically facing a simple choice. It's one thing or the other. And we're going to find out which one it is in just a few days. You can see the two paths right here, clear as day. Path 1, we get a peace deal, or even just an extension. Oil prices drop, inflation fears cool off, and silver probably makes a run for it, breaking higher. But path 2, if that deadline passes with nothing to show for it, the whole conflict could kick off again, sending oil through the roof and likely knocking silver right back down to test its recent lows. It's that black and white.
Okay, let's switch gears. For our second lens, we're zooming out to the bigger economic picture. All this geopolitical tension has backed the US Federal Reserve into a really, really tough spot. It's a trap, basically. And here's the kicker. Silver is one of the few things that could actually benefit no matter which way the Fed jumps.
And the numbers, they don't lie. Inflation is back, and it's being fueled almost entirely by that spike in energy prices. I mean, look at this. Consumer prices, producer prices, they're both heating up. And get this, gasoline prices shot up over 21% in a single month. At the exact same time, the job market is still way stronger than anyone expected, so the Fed has no easy excuse to start cutting interest rates. So here it is. This is the Fed's trap, laid out perfectly. Option 1. Hike rates to kill inflation, but risk absolutely wrecking the economy and sparking a debt crisis. Option 2, do nothing. Just let inflation run wild and risk stagflation, high inflation and a weak economy. They're stuck between a rock and a hard place. And historically, both of those outcomes have been incredibly good for precious metals. And this is exactly why this matters so much. We don't have to guess what might happen, we can just look back. The last time the US was staring down the barrel of real stagflation was 1979. And the result? Silver went absolutely parabolic. It went from about $6 an ounce to nearly 50 in less than a year. Now, that's not a prediction, but it is a powerful reminder of what can happen under these exact conditions.
All right, on to our third lens. Let's step away from all the paper markets and the geopolitics for a second and talk about the actual physical metal. Because there is a massive, and I mean massive, story unfolding here that is getting almost zero attention from the mainstream. I want you to look at this number, 762 million. Let that sink in. That's how many ounces of silver have been drained, just sucked right out of the world's above-ground stockpiles. Think of it as the planet's savings account for silver. Just since 2021. This isn't some forecast. This has already happened. Now, to put that 762 million ounces into perspective, the entire planet mines about 820 million ounces in a good year. So in just the last few years, we've burned through an amount of silver from our savings that's almost equal to an entire year's worth of global production. And that metal is gone. It's been used, it's in solar panels, EVs, our phones. It's not coming back. And this physical drain is happening while the paper market is leveraged to the hilts. If you look at the COMEX exchange, there are about 571 million ounces of paper IOUs trading back and forth, all claiming ownership of silver. But guess how much actual physical silver is registered and ready for delivery? Just 77 million ounces. That's a leverage ratio of about 7.5 to 1. And this trend isn't stopping. This year is on track to be the 6th year in a row that the world uses more silver than it mines. We're looking at a deficit of 67 million ounces. But what's really fascinating here is that this is happening even though demand from the solar industry is expected to fall. Why? Because these new drivers, like AI data centers and EVs, are just exploding and growing even faster.
Okay, time for our fourth lens. Let's put on our trader hats for a minute. Forget the fundamentals, forget the geopolitics. What is the chart itself, the price action, telling us about the battle between buyers and sellers right here, right now? When you look at the chart, the one number you've got to watch is $78. That's the 50-day moving average, and it's basically the line in the sand. If silver can stay above that level, the next stop is probably a test of resistance up around $83. And what's really important is that the momentum indicator, the RSI, is just neutral, setting at 47. That means if silver does make a move up, it would be starting from a place of strength, not from some speculative, overheated frenzy. And finally, our fifth and honestly, probably most important lens. Let's zoom all the way out. Let's look right past this week's deadline, past this month's inflation numbers, and focus on the deep structural forces that are going to define this market for the next 3 years, and probably a lot longer. Okay, this is the single most important thing to get about silver supply. It's what economists call inelastic. Here's what that means. About 70% of all the silver we get comes as a byproduct of mining for other stuff, like copper or lead. So you can't just flip a switch and get more silver when the price goes up. It takes 7 to 10 years to build a new mine. The supply for 2030 is basically being decided as we speak. So you've got this really rigid, inflexible supply. And on the other side of the equation, you've got this absolute explosion of industrial demand that is completely non-negotiable. The global shift to green energy and all this new tech from AI to EVs to 5G, it isn't optional. All of these industries have a structural, unavoidable need for silver, and that demand is just growing and compounding every single year. And this is exactly why the big institutions are seeing so much upside in the long run. We are not talking about small moves here. Bank of America, Citi, they've got bull case price targets well into the triple digits. And it's worth remembering, silver's all-time high back in 1980, if you adjust it for inflation, it would be almost $200 in today's money. So how do we tie all 5 of these lenses together? Well, the easiest way is to think of it as 3 different clocks, all ticking at the same time. You've got the 5-day clock, which is all about that ceasefire deadline. It's super volatile and it's binary. Then you have the 6-month clock. That's the Fed's trap and the inflation story. But the 36-month clock, that's the most powerful one. That's the one driven by the unstoppable forces of physical supply and demand. In that, right there, is the ultimate takeaway. The rest of the market is obsessed with trying to time these short-term headlines. But the real story, the real edge, is seeing how that short-term chaos is playing out inside of a powerful, long-term fundamental story. When you can see that, you can see the whole board. So I'll just leave you with this one question. This week, the entire market has its eyes glued to that 5-day clock. But when you know that almost an entire year's worth of global mining supply has been vaporized from stockpiles, you just have to ask yourself, is the market even watching the clock that truly matters?